The hidden costs of financial planning you must know. They won't advertise this. They won't brag about it. But behind the polished offices and reassuring smiles of financial planners, there lurk hidden costs, silent wealth assassins that can drain hundreds of thousands of dollars from your portfolio over the decades. Today, I'm pulling back the curtain to reveal the dark side of financial advice so you can shield your hard-earned money from fees, commissions, and tactics designed to benefit everyone but you. Imagine this. You've diligently saved, contributed to your 401k, and paid for a comprehensive financial plan. You think your money is on autopilot, growing steadily. But beneath the surface, a massive iceberg of fees is lurking, eroding your returns piece by piece, faster than you realize. After dissecting over 200 financial plans, I discovered a shocking truth. The average investor pays more in hidden planning costs than in taxes. While you obsess over tax brackets and IRA contributions, a silent army of fees chips away at your nest egg. And the worst part? Most planners profit from your ignorance, quietly pocketing a share of every product they sell you. The complexity tax, when simplicity costs you thousands. Financial advisors love complexity. Why? Because complex strategies justify bigger fees. They'll weave together multi-tiered investment vehicles, private placements, insurance wrappers, and alternative assets, all under the guise of diversification. In reality, a low-cost 3-fund portfolio would outperform these intricate arrangements 90% of the time. This is the complexity tax. By adding layers of funds, insurance riders, and exotic instruments, advisors can charge higher management fees, entry commissions, and performance fees. Over 20 years, this complexity can cost you $15,000 to $25,000. Money that could have been compounding in your own account instead of lining someone else's pockets. Your path to simplicity. Demand plain language explanations. If you can't distill your plan into 3 core funds and a clear fee schedule, you're paying for obfuscation, not expertise. Commission conflicts. When your advisor earns behind the scenes. Many financial planners are not fee-only. They earn commissions on the products they recommend. Annuities, mutual funds, insurance policies, creating a massive conflict of interest. They have a financial incentive to steer you toward high-commission offerings, even when cheaper alternatives exist. Insurance commissions can be 5% to 10% of premium dollars. A $10,000 annual premium can generate $500 to $1,000 in upfront commissions, plus renewal fees. Mutual funds often carry load fees and 12b1 fees that add 0.25% to 1% to your expense ratio, year after year. Annuities lock up your money with surrender charges, market value adjustments, and higher embedded fees, sometimes exceeding 3% annually. These commission-based recommendations can shave $30,000 to $50,000 off your lifetime returns. Your money shouldn't be a side hustle for your planner. Your defense. Always ask, do you receive any commissions or incentives to recommend this product? If the answer is anything but a straight no, consider a fee-only fiduciary instead. The Insurance Mirage. Whole life versus term, and invest the difference. Whole life insurance is sold as a safe investment, but its returns are paltry compared to the stock market. The insurance company pockets most of your premiums for administrative costs and commissions during the first 10 to 20 years. For example, $200 per month in whole life might grow to $80,000 in 30 years. That same cash flow invested in a total market index fund at average returns would exceed $250,000. This isn't just a minor mistake, it's a 6-figure opportunity cost. Term insurance plus invest the difference can outperform whole life by $100,000 plus over a lifetime. Understand net cash value versus face value, and always run the term versus invest analysis before signing any policy. The mutual fund trap. Active management's hefty price tag. Actively managed mutual funds promise to beat the market, but research shows 89% of active funds underperform their benchmark over 15 years after fees. Yet advisors keep pushing them because they generate ongoing revenue through expense ratios of 1% to 2%. Compare that to passive index funds, charging 0.03% to 0.10%. That tiny gap can compound into $200,000 plus lost wealth over 30 years. Don't fall for the allure of past performance or slick marketing. Cost drives performance over the long run. Tilt your portfolio toward low-cost ETFs and index funds, and measure your advisor's value by net returns, not promises. Asset-based fees, a fee that grows as you do. Most advisors charge 1% of assets under management, AUM, annually. It sounds small, 1%. But on a $1 million portfolio, that's $10,000 per year. Over 20 years, you'll pay $200,000 in advisory fees alone, plus the compounding returns you never earned on that money. As your portfolio grows, so do their fees, even if their work doesn't. This model disincentivizes advisors from making recommendations that might reduce AUM, like paying off debt or moving to an exercise-intensive account. Negotiate flat or tiered fees, capped at a percentage of assets, or consider fee-only planners who charge hourly or by project. The Rebalancing Racket. Trading fees and tax drag. Rebalancing is healthy, annually, but some advisors rebalance quarterly or monthly to generate trading commissions and justify their existence. Every trade can incur $4 to $10 in fees plus capital gains taxes if done in a taxable account. Unnecessary rebalancing can cost you hundreds or thousands annually, depending on portfolio size. Insist on annual rebalancing and prefer commission-free ETFs in taxable accounts to minimize tax drag. Estate planning. Upsells. When trusts become money traps. Quite often, mid-tier advisors will tell you that a simple last, will and testament isn't enough. They'll push you into complex irrevocable trusts, dynasty trusts, or grantor-retained annuity trusts, all at a cost of $5,000 to $15,000 upfront, plus annual trustee fees of 1% to 2% of trust assets. Yet for over 80% of clients, a basic will, durable power of attorney, and beneficiary designations are more than sufficient. These complex structures often serve advisor revenue targets rather than client needs. Costs. Legal fees, $5,000 to $15,000. Plus, annual admin fees, 1% to 2%. Opportunity cost, money tied up rather than invested. Compounding loss of $50,000 to $100,000. Confirm whether you truly need a trust structure by asking, what specific problem does this trust solve for me? If the answer isn't crystal clear, stick with a straightforward estate plan, the 401k rollover minefield. Upon leaving a job, the temptation to roll over your 401k into an advisor's management account is powerful. They promise better investment options, personalized service, and consolidated accounts. But here's the truth. Your former employer's plan often boasts institutional-grade funds with rock-bottom expense ratios, 0.03% to 0.10%. Rolling over to retail-priced mutual funds, hiking fees to 1%, can cost you $20,000 to $40,000 over 20 years. Employer plan fees, 0.03% to 0.1%. Retail rollover fees, 0.75% to 1.25%. By needlessly converting, you're trading low-cost bloat for advisor margins. Always compare the annual fund operating expense of your 401k lineup with any rollover destination. If it's higher, stay put or transfer only amounts that truly benefit from outside management. Estate durable goods, the trust fee creep. Even if you legitimately need a trust, watch for fee creep. Trustees might charge a base fee, plus additional percentages on asset growth. Over decades, these fees can escalate you into six-figure territory, all to keep your estate plan on life support. Negotiate flat trustee fees or consider using a family member or friend as trustee, backed by professional legal oversight. This can save tens of thousands in trustee fees. Software bias. The Monte Carlo fear machine. In every advisor's toolkit is Monte Carlo simulation software, fancy projection engines that spit out scary scenarios. You have a 75% chance of running out of money by age 85. It sounds authoritative, but these models often incorporate pessimistic assumptions, inflated expense forecasts, and higher than realistic withdrawal rates. The result? You're left dependent on your advisor's expert adjustments. Assumption overload. Overstate inflation by 0.5% to 1%. Understate returns by 1% to 2%. Projection bias. Show worst-case fifth percentile outcomes to scare you. By taking these steps, you reclaim control, transforming yourself from a passive fee payer into an informed wealth architect. Every dollar you save in unnecessary fees becomes a dollar that can compound for decades, potentially turning into $10 or more by retirement. Your future self will thank you for the decisions you make today. If this video opened your eyes, hit that like button and subscribe to Finance Facts for more no-nonsense strategies to safeguard and grow your money. Drop a comment below. What hidden fee surprised you the most, and how will you protect yourself moving forward?